What we're going to do is we are going to evaluate stocks. We're going to find out what drives stock prices. Simple? Not so simple. But in the process of understanding how to evaluate stocks, essentially, what drives the stock price? I am not talking about intrinsic valuation here. I am talking about understanding price risk, understanding what drives the stock. Okay, so how do we go about it? Well, first of all, this channel is now called the $500,000 portfolio. It's a $500,000 portfolio because that's exactly what we're going to get to. We're going to get to $500,000, and you're going to see the progression in my Patreon channel. I will, and I've been already posted all of my trade, and I will show you the Patreon channel shortly. But obviously, we're not going to follow the entire market. I mean, I don't have that kind of brain. What I can do is I could pick certain stocks, certain ETF, and show you. I'm going to show you what drove the price so you understand what to expect next. So you understand the story. So you understand what drives the stock price currently. Now, of course, they don't make it easy for you, right? In fact, they're making it quite difficult because the story is always changing with the stock prices. What I mean by the story? Well, it's basically the narratives. What is making traders and stockholders and everyday people to buy or sell the stock? What moves the stock? Now, how do I find out? Well, first of all, I go on the basis that there's a story to be told. The story changes all the time. That's what's difficult. And but the point is, I don't want to know what made the stock price move in the past. I want to know what's going to happen next. But for you to understand what's going to happen next, you need to know what happened prior, what moved it. So you have an understanding of the elements that you need to look for. So let's start. Let's start with one of the 4 or 5 stocks that I'm following. The first one is called QQQ. And QQQ essentially is a very interesting stock. QQQ basically is an ETF, and it's an ETF that is following the market. This is Invesco's QQQ. It's basically a stock. It trades like a stock, but also it's an exchange traded fund. So all you need to worry about is like a stock. It trades. You could buy it. You could sell it. You could do a bunch of things. You could do like I did. You could buy options attached to the stock. So what does it do? Well, basically, if you look at it, I mean, it's very simple. But if you look at its portfolio, what's in QQQ, and this is what's interesting because you're really playing the quote unquote Nasdaq market. It's composed of Apple, NVIDIA. 8% of the fund is Apple, 8% is NVIDIA, Microsoft. So right there, we've got about 25%. With Amazon, that makes it 30%. With Facebook, that makes it 24, 25, 30, 35. With Broadcom, that's 40. With Tesla, it's 45. You have Costco, 47, 47 with Google, 40, 49. So you know what? Between those 10 guys, we're looking at about 50% of the portfolio. Okay? There's a bunch of others as well. And what it's supposed to be doing, if I click on the overview, that Investor QQQ is an exchange-traded fund based on the Nasdaq 100 index. The fund will, under most circumstances, consist of all stock in the index and includes 100% of the largest domestic and international. Right, so we are basically following QQQ. What moves QQQ? What I'm going to do, obviously, is I'm going to show you the elements that cause the price to move. Now, the way I'm going to do it, I have to tell you, is I'm going to use it with um, a concept called correlation, not causation, meaning I cannot tell you exactly how 500,000 traders think at that precise moment and what made them decide every single one of them. But I'm going to look at what happened to the stock price, right? And then I'm going to look at what happened at that time and see what could potentially have caused it to move, if whether or not that event is important and if it happened again and again. It's like if a duck crossed the street on 42nd Street and the stock market crashed, I'm not going to say each time the duck crosses the street that the stock market is going to crash. Obviously not. But, this is often used, causation versus correlation is an important concept that you need to understand. Why? Because, certain events happen at a certain time and you're saying, well, oh, look, you eat a lot of meat, your cholesterol is high, and you have a heart attack. Therefore, eating a lot of meat causes heart attacks. You've heard that one, right? It's not necessarily true. Okay. But let's not get into that topic. So let's take a look. So the way we do it is we take a look at the chart because this is all about price risk. It's not about credit risk. Not analyzing all those companies and figure out whether or not they're worth what it is. It's not intrinsic value analysis because we essentially put a stock that represents about 100 of other stocks. But it is quite informative, as you're going to see. This takes times. This takes time. This is not something that's done in 5 minutes. You need to be educated. You need to understand what goes on. You need to realize what's really happening. So basically, we're in November. And again, I'm not going back 100 years because I'm not that smart. I don't remember that many things. I'm just looking, and because the story is literally going to change every day. Now, if you follow my Patreon channel, every day I'm going to come in, I'm going to tell you, oh, look, this is what happened to QQQ. Oh, look, that's what happened to another stock that I'm following, VMC. Oh, look, that's what happened to Tesla. And as I am showing every day, it's like showing you how to ride a bicycle. You will learn to understand, okay, so that's what's moving the price. So the arrow right here represent when I start putting some trade at that level. I put it around 515 or so. Why? Well, quite frankly, this thing is moving up. And it was kind of plateauing. And I said, it's going to keep going up. I mean, after all, we have low inflation, we have no recession, and I am expecting rates to come down. And frankly, I am looking at lots of Nasdaq tech heavy, good earners without no risk of default. And we're talking about NVIDIA here. We're talking about Tesla. This is a creme de la creme. So for a while, and of course, I bought an option, and that's going to expire in February. Now, keep in mind that this particular February option basically, and if you look at my Patreon channel, you will see that it trades about 12, 13, 14 times higher than the stock. So basically the stock goes up by 1%, the option goes up by 15%. So we were minding our own business in November 15th, right? And then up to November 15th, something happened. We take a hit. We took a hit. We took a hit on November 15th. What happened? Well, this is what happened. Right? Two firm inflation print just made the Fed 2025 cut path a lot murkier. What does that mean? Well, the October inflation reading have shown little progress towards the Fed. Now, the Fed, you need to understand. I mean, I mean, I don't want to teach it all the time, but basically you need to know certain things, right? You need to know that the Fed is looking for 2% inflation target. When we say inflation target, we're talking about the CPI. We're not talking about the cost of a gallon of milk, which went up 30% since 2020. That is expensive. Inflation is present in our day-to-day life. We're just talking here about the CPI, the Consumer Price Index, which is a number that the Fed measures and is supposed to measure the amount of inflation. I'm not going to go into detail as to what the CPI is and how it's calculated. I did a bunch of videos on that. But basically, they're looking at this number and they want the number to go to 2%. And right now, they show that that number technically increased, at 3.3% for the third consecutive month. They want it, I mean, they don't want decrease in inflation. They want inflation to go up, but they want 2%. Here, we're stuck at 3% in October. Then on Thursday, the core producer price index, because that's not really what they were, the release was on the PPI, reveal, which is a producer, the money spent by the bosses, the companies, reveal prices increased by 3.1%, up from 2.8% the month before, and above economics expectation for a 3% increase. So they thought that, this thing was under control, but obviously, we are kind of not going the way. Now, keep in mind that it increased 2.8% the month before, right? And it went up 3.8, 3.1% in October. So we're in almost a three category and moving up. And in addition to that, they were expecting 3% from 2.8 and they got 3.1. So it's a bunch of expectation that didn't go anywhere. So everyone was very disappointed. And obviously, that you got that number, you got that first drop. Now, is that what caused the drop for people to sell? I mean, it's a there's a correlation. It's linked. Now, what can I say? Well, you have to understand that, the market really doesn't do well with high rates. In principle, in finance, the higher the rate, the lower the valuation. That is a principle. Okay. So you want low rates. You want low rates because that increases the valuation. If you're going to hunt for gold in Alaska, right? And you're saying, well, I want to borrow some money. How much money are you going to give me? I'll give you 100 grand, but I want a 50% return on my money. I don't want 4% because this is a very risky endeavor. And so the riskiness of the transaction, pushes up the the rate. It pushes up the rate, but it also pushes down the valuation. So for you to get the valuation back up, you need to earn that much more money to keep it up, basically. So in finance, there's an inverse relationship between rates and value. As simple as that. So if someone is telling me that we have inflation that is not going as fast as we thought down as possible, so that means when the Fed meets in December, which is pretty soon, they may not lower the rates because we still have inflation. Because the way to fight inflation is by raising rates. So if you have inflation, you're not going to lower rates. That's crazy, even though they said they would. The point is, this is kind of the discussion that goes in everyone's mind, and that's what caused the price to drop at that point, right? So let's go back. Let's go back to our chart and see. Okay, so we took a first hit. That was a decent hit right there, right? That was a decent hit right over here. Here's our hit. We took a hit right there. Now, and it was a pretty nasty hit. We went from 515, right, and drop and drop and drop and drop, and we kept on going down to almost less than 500. So we lost about 15, 20 points. 20 points on 500. That's 1% would have been 5. So we lost 4%. That's a tough hit to take, right? From 500 for 494, we lost about 20 points. So 10 points is 1% is five. Yeah, 20. That's 4%. Boom, right there. And of course, if I go 4% here, my option, guess what? Goes down 4% times 50, 15. That's almost 50%. So the lost half of the value just like that. I know. And this is the game you decided to play. But no panic because you know that at the end of the day, the proof is going to be in the pudding. What is the Fed going to do? Because you need to understand the Fed has two mandates, right? Well, yeah, they want to, and I put a video. I'm going to put a video out on that pretty soon. Yes, the Fed wants to reduce inflation. So therefore, if there's a problem with inflation, they're going to keep rates up or even increase the rates. I mean, they're not going to increase the rates, but at least they're not going to decrease it. But they also are very concerned about unemployment. They want to make sure that unemployment is under control, which means that if you raise rates and people don't borrow money and people don't create businesses and it's difficult for them to maintain their business, they won't hire as much, that is not going to be very helpful to unemployment. So to that end, they could actually lower rates because they don't feel that it's such a big deal right now. But if they don't lower rates enough, unemployment was been kind of going up, not a lot. We're around 4%, but they don't want any issue with unemployment. Okay. That's a situation with unemployment. So you need to realize that. So what are they thinking about? And this is where it becomes interesting. This is where the rubber meets the road. What is the Fed really thinking? And this is what everybody's trying to figure out. The big question, and this is a huge question. This is a very important question because this is how you make money or you lose money in this case in the stock market, especially if you work with options. So essentially what happened is you could see QQQ kept on dropping, and kept on dropping. So the story at that point was that we were going to have an issue with the rate. Okay. But then suddenly after we saw a reversal. So now, I mean, this the news is still out, right? The news about the rate decrease, potential inflation impact is still there. That news is still out, okay? And we're still suffering here. But then the story changed. The story changed because um, on the 20th, okay, let me show you the next thing that happened. Okay. On the 19th, everyone to focus on, guess what? NVIDIA. We started focusing on NVIDIA. I mean, you could see QQQ at that time was 0.88%. Don't forget, we lost 4%, right? The last of the Magnificent Seven is set to report earnings. Now, QQQ, remember that NVIDIA is about 8% of QQQ. And there's a lot riding on the outcome. NVIDIA, the AI chip giant, has powered tech stock to enormous gains, and they want to know how the stock is going to do. So now the story is changing. The story is moving now to, well, let's see what NVIDIA is going to do. Let's see if they are going to produce what they said they were going to do. You see what happens here? You see what they do? How can average in heavy while minimizing downside risk? How could you How can you average in heavy while minimizing downside risk? I mean, at the end of the day, if you dollar cost average, you should be fine. But here we're talking taking advantage of the market, taking advantage. We're talking learning. We're talking getting into the weeds like they do. And I'm showing you how they do it so you really understand what's happening. It's like riding a car. You got to drive it a couple of times. And you can't drive all cars. You can't drive, you know, a F-150 the same way you drive a Lamborghini or Mercedes SL 500, or Porsche GT, right? You got to be careful. You got to learn everyone has its own pattern. And that's what you need to do here. You need to understand what happens. So in this particular case, we are concerned about inflation and now the market, and this is something that you need to learn, which is true. The market is fickle. The market is very fickle. So now the market is thinking, oh, you know what? How about NVIDIA? I mean, after all, QQQ is 8%. And what does the market do? As of course, I mean, NVIDIA is kicking butts. So what happens? Well, as they're releasing the expectation builds, the stock goes back up and he goes back up and he goes back up. And of course, they have good earnings. So, all news, as you could see, right? As you could see here, we did well. We just rode this little guy all the way here. And then, of course, on the 25th, on the 20, on the around this, something happened on the 21st. Something happened on the 21st, which let me show you. So you see, now we're talking about this thing here. See this? Okay. So the 21st is this. As you could see, jobless claim fall to 7-month low, show labor market trending sideways at a healthy level. So now, do we have a problem with unemployment? Weekly jobless claim rose less than expected, reaching a 7-month low. Right? New data showed 213. So yeah, this is good news. We have less unemployment. But if you were thinking that the Fed is concerned about inflation and they were not going to stop raising rates because they thought that maybe we have a problem with unemployment, but here it's tell you, but you know what? We don't really have a big problem with unemployment. In fact, it's going the other way. Right? So 213 were filed, jobless claims were filed instead of 219 versus the 220. Economists thought, you know what? We have 220,000 people filing for claims. In fact, only 213 filed. So it's a good news unemployment. So maybe, you know what, Fed, maybe what you can is you could stop lowering the rates because you could also take care of this inflation problem that you have. And you don't need to worry too much about unemployment. You see what they do? See what's happening here in the market? Now the story is changing. And of course, it's an important story because you got to wonder, what is the Fed thinking? What would you do? What's really happening? Do we have an inflation problem or do we have an unemployment problem? Well, it doesn't look like we have an unemployment problem based on the number that I just saw. But do we have an inflation problem? Well, it looks like because it's going sideways. So then it means that they are going to stop lowering the rates. Well, that's catastrophe. That's not good. We don't want that. Okay. And this is kind of you saw here. Boom, we went back down again, back to 498. So you see, we went back down to 498. See right there? So as you could see, the market can be very, very, very fickle, and you need to understand it. And the reason you need to understand it is because if you don't understand it, then they are going to take advantage of you. Okay, so now we are on the 27th, 21st, and the market now somehow recovers over the next couple of days. I mean, slightly, right? You could see we're mumbling along because at the end of the day, they say, listen, this is, don't forget. I mean, at the end of the day, NVIDIA and these guys are doing great, so it's pushing the stock up as well. Okay, in its own, in its own way. Now on the 25th, this is what happens. On the 29th, on the 25th, which is around that time, you could see we want to go up. There's a pattern here. See, we want to go up, and then boom, we have the negative news about earnings. Then we about the unemployment and the rate. Basically, it's rate tied to rates. Then we kind of tag along, and we're doing well. And then we get hit again. We get hit again here on the 25th. And the reason why we get hit on the 25th is because of this. Right. So basically, key inflation gauge shows PCE going sideways. And then, of course, let me show you. Right. It says right here, the last reading of the Fed preferred gauge. So the PCI, the personal consumer expenditure strips of energy is at 0.3% in line with expectation. So on the prior, over the prior year, core prices rose 2.8%. On a yearly basis, overall PCE increased 2.3%, a pickup of 2.1% in September. I know it's kind of mumbo jumbo, but basically what we're saying is that it rose 2.8% in line and above 2.7. So it's not rising a lot, and so has been going sideways in the past. So but the point is that it's not going down. Okay, and it's not going down. And so another inflation gauge tells you, okay, well, we need to worry about this inflation. You need to do something about it. And the way you're going to do something about it is that you're going to lower, right? You're going to stop lowering those rates because we have to fight inflation. We don't seem to have a problem with unemployment. Is that what's happening? Well, that's what the numbers are showing you. Okay. Hold on. The story's not over yet. The story's not over. I'm still teaching you what's going on with the movement of the stock, right? So then obviously we get hit here. That's what you're seeing here. Bam, again, because this is inflation and employment, inflation, right? Those two numbers are driving this thing. But then people forget the market moves, and then we are kind of here right now. The market is moving back up since the 29. And why is it moving back up since the 29? It's fairly simple. It's moving back up because of this. Wall Street issues most bullish S&P outlook yet for 2025. Okay, Wall Street high watermark for S&P projects a nearly 17% increase from current level at the end of 2025. They're seeing 7,000 for S&P 500. They're seeing huge growth in unemployment. I mean, in GDP, 4%, 3%, rare combination. So you have low unemployment rate, high growth, added that the prior period with similar economic backdrop include the 60s. and they're back to the 90s, which shows strong equity performance. Look at the growth that they're seeing for the S&P 500. So all positive stuff right now. And that's the reason why you're seeing this chart. I mean, let's take a look at what happened recently, right? So basically the 29th, look, look, we've been going up quite a bit. That was yesterday, right? I mean, Friday. We ended up at 1 o'clock, but we just took off. We're on the trend up. Look, trended up. And in fact, now the aftermarket is up 0.09%. We're getting back to our 515 level. Okay, so, and as I do this, basically, I'm on my Patreon channel. So I showed you in my Patreon channel what is it that I do. And what I do is I trade, I show you the trade, like I put on QQQ, right? 10 quantities of $20. And I show you my trades. And you could follow them and you could understand what's happening and see them. And you could see QQQ tied to rate cuts. I explain every day. I do this video, but not video, but I explain to my Patreon channel exactly my Patreon what it is that's happening on all four stocks, the stocks that I'm following, which is GCT, Tesla, QQQ, VMC. Now I might want to follow another one. That's what it takes to make money in the stock market. You need to understand what is going on. How do you understand what's going on? Well, you watch, you learn. You don't you don't read. You don't read a book, okay? You don't read a book to understand what's happening. Like in everything, right? How'd you learn anything? You learn by doing. How did you learn to ride a car? How did you learn to ride a bike? You got on it and you tried. And that's exactly what we're doing with. This could be very, very profitable for you if you understand what's going on. What's going on right now? Anything having to do with the Fed lowering rates is going to be good for the QQQ. And if you don't hear anything, even better. Then the market will just naturally go up because these are great companies, you know, Tesla and QQQ and Amazon and NVIDIA and all that. But for example, on Wednesday, Jerome Powell is going to be in New York. He's going to be give a speech, you know, and so is Bill Clinton and a bunch of other people. But they're going to want to know, what is he going to say? What is Jerome Powell going to say? Is he going to give some indication as to what he's going to do with the rates? So let's make money on that day. How do we make money? Well, let's see what he's going to say. Because if he says anything about the fact that, well, inflation is not a problem, then we're off to the races and he's going to lower rates. If he says things like, I'm a little bit concerned about unemployment, even better. But if he says unemployment is not a problem, but inflation, I'm a little concerned, then you're going to have some problem in the stock market. So you have to be careful on the trade. The point is, how do we know what he's going to say? And that is how you make money in the stock market. If you know what he's going to say on that day, then you could position yourself. Now, of course, you need to understand one thing is, yes, maybe he says something that's not going to be good, but ultimately, what do you think he's going to do? What do you think he's going to say? Now, I could tell you, and this is important. Listen to me just a second. Don't forget to subscribe to the channel. It's important to understand that he's just not alone in his office deciding all these things. He's got board members, and it would appear based, and I did a video on that. That's going to be coming out shortly. It would appear that based on the survey, the board members of the Federal Reserve are more concerned about the fact that they're more concerned about unemployment and less concerned about inflation, meaning they rather get inflation wrong than get unemployment wrong and by causing unemployment. I mean, that's kind of the thinking. So therefore, more likely than not, they are going to lower the rates. Why? Because they don't want a problem with unemployment. But unemployment seems to be under control. Well, I mean, we are still getting lots of claims. Let's not forget that whenever you raise rates, which we've done in the past, it takes several quarters for it to hit through. We may get hit with unemployment at some point or slowdown in the economy, maybe not a recession. What we want is we want a soft landing. That's a key word. As long as we have soft landing, he's going to keep lowering rates because he doesn't want a hard landing. I mean, inflation is under control. I hate to say that inflation is under control because most of you say, are you kidding me? Look at the price of oil and the price of eggs and milk and all that. I know that's still very expensive. I agree. But they're not looking at the real number. They're looking at the CPI. So then logically, what you should be thinking about is saying, well, okay, so basically they're very sensitive to rates, okay, but then eventually, once they stop talking about rates and what he's going to do or not going to do, the market moves up naturally because at the end of the day, we still have a Trump trade, we still have a great economy, we don't have a recession. Trump has a lot of things that he's going to do that we don't know yet. Some of them may work, some of them may not work, but it's probably going to be good for business. Okay, we have a clear direction. We're going to have lower rates. So the the S&P actually is supposed to go up by 12% in terms of earnings versus 4 or 5% in the third quarter versus the fourth quarter. So everything is pointing towards, I mean, all these people are saying up and up and up. But you want to know what to do because I mean this option that I have expire in February. I'm not waiting forever. If it's forever, I don't care. But now I need this thing to go back to 515 as soon before February. So what's going to happen? Well, more likely than not, if you know anything about the Fed and you know that they are more worried about unemployment, they're probably going to cut those rates. So you could say lots of different things on between now and then, a lot of uncertainty or whatever, but they are going to cut the rate because if they don't cut the rates, right, it's going to indicate to the market that we have an inflation problem. And that's not going to be good. Now, of course, Powell and Trump have a very, very distraught relationship right now. He doesn't like the guy. Is he going to be spiteful? Is he going to want to be liked by Trump? I don't know. We'll see. We'll see what the intent is. But if that's what he wants to do, then he could say, you know what, I'm not moving rates because I'm concerned about inflation. What? And you're going to put all these people out of work? Sure. You like the other guy, you don't like me, and that's what you're going to do. So that's going to create unemployment. There's a certain amount of uncertainty here as well that you need to be aware of. But apart from that, we're going to assume that he's apolitical. Not always the case for Fed Reserve Chairman, but we're going to believe that he's apolitical. Therefore, he's going to cut rates. Therefore, eventually, QQQ is going to keep inching up and up and up and up. And that is how you understand how the what moves stocks. It's basically the price risk. That's important. That is what you need to understand. That is what you need to follow. But you need to learn. This is not just listening and say, okay, what should I buy? No, you yourself need to get a feel for what it is because it's your portfolio, it's your money, and you have to decide where to best invest it. But the more informed you are, and the way you get informed is how it moves. And that's what I'm going to be helping you here on the YouTube channel, but more precisely every single day, I will be telling you what I'm doing on QQQ, what I'm doing with VMC, what I'm doing with GCT, what's going on with Tesla. So you learn every day what is driving the price so that then you could make informed investment decision and make money in the stock market because at the end of the day, that's the goal.